Hello friends, wish you a very happy new year. And when we are looking at a new year, we are in the brink of having a new tax by the name of GST. And here I am before you today to explain you some of the important characteristics of this new tax known as goods and services tax. Friends, as you are aware, the indirect tax framework in the country today is plagued with lots of indirect taxes. You have central excise duty or countervailing duty when you manufacture or import a product. Thereafter, when the product moves within the country, it bears plethora of taxes like octroi duty. Also, you have at times VAT and GST depending on whether you sell locally or interstate. And then there are service taxes which are applicable for services which are being rendered. When we have these types of selective taxation, the industry always keeps on complaining that there is a lot of tax impact and also there is a lot of inefficiency in terms of claim of credit. This is because traders are not eligible to claim excise or service tax credits, whereas service providers are not eligible to claim VAT credits. This results in a lot of cascading, lot of uncertainty, and the industry generally finds that the indirect tax starts interfering into the day-to-day transaction structures of entities. In fact, even if you look at a software industry, they are so plagued by this entire controversy of whether a software constitutes goods or constitutes services. And ultimately most of the software companies started paying both VAT and service tax, though even the Supreme Court has said that both the taxes cannot apply. So this is the state of affairs which exists in the country. Along with this, we have a lot of bureaucratic approach, multiplicity of taxes, disuniform structure, different tax rates across the country, a clear recipe for disaster and a big impediment into the ease of doing business, which is the stated objective of the government. And that is where around a decade ago we started with our exercise of finding something which is simpler, something which is much easier for the businesses to administer in terms of an indirect tax regime. When we started that journey, we found that there are more than 150 countries in the world which implement a simple tax known as goods and services tax. Some countries name it goods and service tax, whereas some other countries name it as value added tax. Irrespective of the nomenclature, one thing which was uniformly found across these countries was that the countries did not go into too much of over verbiage or too much of classification. They said we do not want multiple words like excise, VAT, sale, manufacture, service, works contract. They said let us have a neutral word like supply. And moment there is an invoice, moment there is a transaction, moment there is a supply and an invoice is raised and money is exchanging hands, there should be a tax and there should be a single tax known as GST. So with those ideals we started our journey and we said that yes, this is something which will interfere least into businesses and will necessarily imply a huge economic growth by way of an increase in the GDP. When we started this exercise, we found that the constitution in India provided for powers to the center and to the states, and therefore due to the unique federal structure it was not possible to implement a GST the way it exists in most of the countries in the world. We said that if there is a single GST, the states had concerns relating to their revenue and also relating to their autonomy, and therefore as a compromise the country agreed on a concept known as dual GST. The Constitutional Amendment Act, which was passed in August 2016, essentially embodies this concept of dual GST. Friends, make no mistake, when this historic step of the Rajya Sabha approving the Constitutional Amendment Bill was passed, media kept on flashing one nation, one tax. But essentially, this is not a one nation, one tax. It is a tax which is uniform across the country, but it is in two layers. There is a central component of GST which we will be knowing as CGST. There is also a state level component of GST known as SGST. And the moment you bring the central GST and the state GST into picture, the fact remains that India has a multiplicity of states and therefore there is a need to address situations wherein there is a cross state transaction. For example, a person purchasing a mobile from another state, he might be located in Gujarat, but he might buy a mobile from a dealer in another state. In these types of situations, to address the state which will take the tax, we have a third concept which is known as integrated GST. So while we have 150 plus countries in the world implementing GST, we have only 5 of them who work on this concept of dual GST. and none of those 5 countries have this concept of IGST. In that sense, IGST is an invention of our country, whereby what we try to do is the tax is paid in the place where the dealer is located, but through a back-end settlement process, the tax goes to the government of the buying state, and that's where we see that the IGST concept enables free flow of credits from one state to another. In that sense, it's a very unique proposition which we have tried to identify for the country, and many other countries are looking forward to a successful implementation of this concept. And that's where we believe that there is a lot of learning and unlearning which will be required for the industry at large and dealers and traders in particular. Today, the entire tax on goods is based on origin, which basically means that the state from where the goods are sold, that state gets the tax, whereas under GST it is going to be the destination state which will be acquiring the tax. In that sense, the entire structure in the economy is likely to change, and we will find more revenues accruing to the destination states as compared to the originating states. This is one of the challenges which producing states like Maharashtra, Gujarat and Tamil Nadu initially had. As time progressed and political dimensions changed, we found that Tamil Nadu was a state which kept on opposing the introduction of GST. Thereafter, under the constitutional amendment bill, the states have been given a guarantee that if there is any loss of revenue, that loss of revenue will be compensated to the states for a period of 5 years, along with additional markup of 14% for each of the years. A growth rate of 14% is assured to them for each of the years, and that's what has enabled the GST to move forward. And at this stage, of course, I'm sure most of us would have a $1,000,000 question that when is GST going to get implemented? And that's where we see lots of meetings which are happening amongst the GST Council. There's a state of readiness. Every second day there is some announcement from the government or some development from the government. However, the issue of dual control is something which is still not resolved, and therefore there are lots of steps which the government also will need to undertake. The stated ambitious date of GST implementation, as the finance minister says, is 1st of April 2017. In any case, the government needs to introduce GST latest by 16th September 2017, and therefore, in the words of the finance minister, we do not have the luxury of time. Which date between these two dates is anybody's guess, and it will depend on how the events fold over the next few months or the developments which happen at various levels. But yes, the GST is a reform which is definitely going to come, and that's where we need to understand what are the taxes which will get subsumed into this concept of GST. So we have various taxes which will go away. At the central level, we have excise duty, countervailing duty, service tax, and various cesses and additional excise duties. All of them will disappear, and instead of that we will have a single consolidated tax known as CGST or central GST. At the state level, we will have VAT, CST, octroi duty, entry taxes, LBT. In Maharashtra we have various municipal corporations which levy LBT, so that is likely to go away. We have purchase tax in the northern states which is likely to go away. We have luxury tax which goes away when you stay in a hotel. When you watch a movie, there's an entertainment duty which goes away. All in all these state level taxes get subsumed into the concept of SGST, and we will have a single SGST instead of these many taxes. So when you look at it on a snapshot, while we would have loved to have one GST, yet we are having two GSTs, which is CGST and SGST, and between these two GST we are actually substituting 14 or 15 existing taxes. In that sense, essentially I would believe it is still a landmark reform, and therefore it's still a process towards an improvement. As I was highlighting, yes, when we have CGST and SGST, we also bring in this concept of IGST, which is basically a tax which will be applicable when there is an interstate supply. And friends, make no mistake, your transaction will either bear a combination of C plus SGST or IGST. You will not have combinations like C plus IGST or S plus IGST, and you will not have C without S or S without C. Both CGST and SGST will apply on a same common base, and that is the biggest advantage which we are looking forward from GST, that while there are two pockets where the taxes will be paid, essentially the systems, the processes everything and the basis of calculation will remain similar across the country and similar across the taxes, and that is the advantage which we are broadly looking at. So how does this dual GST work? We can look at it from various scenarios, and the first scenario is a scenario wherein you are importing a product from outside India. As of today, at the time of importation, you have a basic custom duty. Along with basic custom duty, importer needs to pay a countervailing duty and a special additional duty. Under GST, the countervailing duty and the special additional duty get subsumed into IGST, and therefore at the time of importation, in the bill of entry, along with the basic custom duty, IGST would have to be paid. This IGST paid would be available as credit immediately to the importer, and therefore there is no locking of funds. And as a dealer is concerned, a dealer importer or a trader importer who today is unable to claim CVD credit and gets back SAD refund by way of a cash receipt after a few months from the government, that changes, and he will definitely see a price realignment wherein he will be able to sell the product at a lower price and also enjoy a cash flow at the benefit at the same time, and that is where we see an advantage in the importation leg. Once a product is imported, there can be a situation of the sale of that product within the same state. Because of the dual GST concept, this transaction will attract both CGST as well as SGST, and while paying the C and an SGST, the importer will be in a position to claim back the credit of IGST. And this is the next important design benefit of the concept of IGST. What we are allowed is a credit fungibility, whereby an IGST credit can be adjusted against CGST as well as SGST, and therefore the interstate nature of the tax now converts itself into the local tax, and it is utilizable for paying my local output tax liability. Same way, thereafter, let's say if I procure locally and sell interstate, then on the local procurement I will have a C plus SGST, and on the interstate supplies I will be paying an IGST. I am permitted to adjust the local taxes against my taxes which are due on interstate supplies. Essentially, therefore, IGST acts as a bridge and enables a very seamless and a free flow of credit across the country. When we are looking at it in this fashion, an immediate doubt which would come to anyone's mind is the fact that because of dual GST, if there is a multi-locational entity having branches across multiple states, there could be situations that there will be credits in one state and output taxes in another state. An entity might purchase in one state, branch transfer the goods to another state, and then sell it from another state. In these types of situations, the fear which was existing in the industry was that in the first state you will have credits which you might need to then lock your money into the government, and in the second state you need to pay the taxes. And that's where the industry itself went ahead to the government and recommended that why don't you please tax the stock transfers. Government was more than willing and obliging to do this, and therefore we have a situation wherein we have a tax on interstate supply of goods and services. What it essentially means is that every movement of goods or services from one state to another would be a subject matter of IGST. When the sending branch pays the IGST, it can utilize. Therefore, the IGST which is paid on the stock transfers in the sending state would be paid through adjustment of input credits on the procurement side, and this IGST paid would be available as a credit to the receiving branch, and therefore what would essentially happen is there will not be a cash flow alignment or cash flow related issues. While this is useful for a product company, it presents challenges in case of service industries, wherein there is always an ambiguity on the quantum and the valuation of the services. So organizations which are multi-locational will really have to set up systems to identify these branch transfers of goods and services, identify a value to it, and pay the taxes thereon and claim the credits in the receiving states. Of course, what we are also told is exports of goods and services would be zero rated, which basically means that you will not pay a tax on the revenue side, on the income side. At the same time, any taxes which are paid on the inputs will be available as credits to be adjusted against the taxes payable on domestic transactions. If you are primarily an exporter and you do not have domestic taxes against which to adjust the credits, you are also given a refund. Essentially, this grants competitiveness to the exports, where the entire objective being that we do not want to export taxes. We only want to export goods and services so that the country earns more foreign currency, and that's where we grow on an organic level. So that is where we have various dual GST scenarios which we are talking about. And essentially when we look at this entire structure, what we are talking about is a seamless flow of credit which enables the GST to be in the nature of a wash tax as far as B2B transactions are concerned. By the concept of wash tax, what we mean is the supplier collects the tax and pays it to the government. Essentially, the government does not get the revenue. Though the tax is paid, it is more like a mirage. The same tax is available back as a credit to the buyer, and therefore the government merely acts as a trustee. The entire circle continues, and effectively neither the seller pays any tax nor effectively the buyer bears any tax. This is the fundamental nature of an indirect tax being a creditable tax, and this is what GST enables in a very seamless manner vis-a-vis B2B transactions. As far as business to consumer transaction is concerned, wherein the product finally gets consumed at the last leg, necessarily the tax has to flow to the consumer, to the state government where the consumption happens, and the central component goes to the central government. And this process continues even under the IGST, wherein for an interstate supply also, because of the destination principle, the wash nature of the tax continues, and the receiving government necessarily will be in a position to grant a credit, enabling the smooth flow of credit in case of IGST as well. And that is where we look at the dual GST concept. On an overall basis, as far as product companies are concerned, they are more than happy with this consolidation of taxes. In fact, it might present opportunities for price realignment because of the subsumation of excise and the VAT. In fact, the very fact that the CGST and SGST are both to be applied on a common base and not to be loaded on each other itself results in 1 to 1.5% effective tax rate reduction. Of course, we will have to ultimately wait for the final tax rates to decide the actual benefits or disbenefits to the specific products which are bearing the taxes as of now. But on an overall basis, the product companies might not see a major disadvantage. They are anyways used to multiple registrations and multiple compliances. All in all, it's going to be useful to them. But when you look at service companies, that is where they would face challenges. Firstly, their effective rate of tax is likely to go up from 15% to 18%, which by itself is a challenge in terms of the cost effectiveness. More importantly, they are now under a cushion of centralized registration. Instead of that, they will now be required to obtain state specific registration. They might need to decentralize billings and pay taxes in those respective states, and this is something which might result in lots of complications, especially in cases where services are jointly provided by more than one branches. Especially advisory services are scenarios where there could be a possibility of a joint service, and that is where you might see some challenges coming. And with that background, I'll just take a few minutes explaining the fundamental principles of GST. And the first fundamental principle is that GST is applicable comprehensively on all supplies. The term supply is defined to mean any form of supply undertaken for a consideration, and that is where we say that the consideration is an important anchor point for the levy of GST. The GST is working only on the concept of consideration. There is no concept of MRP. So therefore, today in excise we have various products wherein the duty is payable on MRP basis. That entire concept goes away, and GST will always be payable only on the money which is transacting hands. And this of course is subject to a few exceptions which are mentioned in the deeming fiction, and two important exceptions in the deeming fictions relate to supply of goods and or services by a person to a related person without any charge. In that scenario, we have been told that any free supply by an entity to a group entity or to a branch without a consideration will be deemed to be a supply. There will be an artificial pricing which will have to be defined, and a GST will have to be paid on that transaction. At the same time, when you have transactions with group companies which are at a subsidized rate, there also we will see challenges, and a transfer pricing concept applies, and you have to make sure that you are raising an invoice at an arm's length price. If not, you would still be required to pay GST on an arm's length price. There are specific valuation rules which typically define the value to be the value which is charged in the invoice. we are told that if there are pre-supply discounts or discounts which are agreed prior to the supply but provided later, they can be adjusted through a credit note, and that will go on to reduce the value and therefore the consequential GST liability. While we are talking about all of this, we also need to understand that there are a couple of aberrations in the existing law which continue, and the first aberration in that regard is relating to the continuation of reverse charge mechanism. So even today, under the service tax law, there are various services on which the service tax has to be paid by the service recipient rather than the service provider. For example, goods transport agency services, lawyer services, and sponsorship services, etc. Under GST, that concept of reverse charge mechanism is going to continue, and therefore you might have a list of services on which GST would have to be paid by the service recipient as a reverse charge mechanism, and he would also be obliged to pay reverse charge mechanism in case of certain types of products also. One more important obligation which comes is that in case of reverse charge mechanism, the service recipient is also expected to raise an invoice on himself and account for that invoice and upload that information into a GST portal. I'll be talking about GST portal in a few minutes from now. That takes me to the next aspect, which relates to the valuation, which we have already talked about being in the nature of an arm's length pricing. The next question which most of the people have is what is the likely rate, and that's where the GST Council has agreed on 5 slabs of rates ranging from 0%, 5%, 12%, 18% and 28%. Over and above these 5 rates, for certain types of products like luxury cars and soft drinks, we might also have a cess, and that cess rate also will come separately. And that's where we see a little bit of a challenge that as far as cess is concerned, that is a separate mechanism and there is a separate filing requirement as compared to the general tax. It would have been better if instead of having it as a cess, the basic GST rate itself was kept at a higher level. But because of various reasons, the law caps the upper GST as 28%, and therefore where the government wants more than 28%, they will impose it through the imposition of a cess. In GST, one important principle is there should be least possible exemptions, and to achieve that objective, most of the existing exemptions are likely to go away. At the same time, there would still be a small scale exemption, and that small scale exemption has been fixed at 20 lakhs in general. However, for northeastern states and for Uttarakhand and some special states, the exemption has been pegged at 10 lakhs only. Any person having a turnover above that is mandatorily required to register and comply with the regulations. Of course, for a small SSE having a turnover up to 50 lakhs, there is an optional composition scheme also which will be available, wherein they will not be eligible to claim credits, but they will pay a very low tax, and that tax again will not be available as a credit to the customer. So typically when you look at small retail outlets, they might choose to go in that composition option. However, composition option is available only to manufacturers and traders, and that option is available only if the aggregate turnover for the entire year is below the value of 50 lakhs. While I was talking about aberrations, one more challenge of aberration is relating to the time when you end up paying a GST. In service tax, GST is payable at the time of invoicing or advances, whichever is earlier. Whereas for goods, the GST, the VAT is payable only at the time of invoicing. Advances in respect of goods do not attract any tax. The tax is payable at the time of invoicing. In GST, there is a paradigm shift. What we are told is, like services, even for goods, advances would become taxable. There is a very elaborate process of managing these advances, raising documents for that, uploading it on the portal, having systems to take care of it. All of that makes the entire process very, very difficult administratively to comply with, and that is where we felt that it might be better if the things could have been a little bit simpler. We talked about the dual GST concept, and at that point of time we said that it will depend on the location of the supplier and the place of supply. If both of them are within the same state, we will have an intrastate supply liable for the local tax of CGST, SGST, and if both of them are in two different states, based on the destination principle, the IGST will apply. Same principle applies for goods as well as services, and therefore for goods we are told the state where the movement of goods terminates is the state where the place of supply is defined. However, in triangular situations where you bill to one party and shift to another party, we are told the predominance will be decided based on the bill to address. And this again is a paradigm shift from the current regime wherein it is only the origin of the movement and the destination of the movement which determines the tax consequences. In GST, for goods, the tax consequences would also be determined by the billing address, and that is where contractual obligations will come into play. Similar logic would apply for services as well, wherein we are told that you have to look at the address on the record of the customer. If the address on the record is in a particular state, the tax will be payable in that state, and this works with our generic principle of destination based consumption tax. However, in services there are certain exceptions which are laid down, and one primary exception relates to immovable properties, wherein we have a source rule, which basically means that any person providing a service connected with an immovable property will not be able to pass on the credit by way of IGST. It would always be a local tax as CGST plus SGST. Therefore, a hotel, a warehouse having customers within the same state, they will be able to pass on credits, but if the customers are in another state, then the credits will not flow because IGST principle will not apply due to the exception rule. And that takes me to the next aspect, which is the core of GST, being the input credit. And this is where we see that while on So friends, we started our talk on GST by explaining the concept of dual GST, and that's where we talked about the scenario wherein we have a situation of a person selling goods from one state to another, and we said that there will be an implication of IGST on those types of transactions. Essentially, when you look at this entire concept, the concept is based on the levy, wherein there is a classification between intrastate supply and interstate supply, and this classification is based on the location of the supplier and place of supply. When we look at the place of supply, it is destination driven, and therefore when the goods move from one state to another, the destination and the place of supply would be the second state, and therefore it would be constituting an IGST transaction. However, there is a fundamental departure from the current regime, wherein we are told in case of tripartite transactions wherein a person bills to one party and ships to another party. In that scenario, we are told that there will be a deeming fiction whereby the first transaction, the place of supply will be the location of the bill to address, and accordingly the GST will apply along with corresponding credits. And friends, that is where we come back to the aspect of no exemptions being available under GST. And that is where we talk about the removal of documentation as well. As of today, we have n number of documentations under the CST law. We have a C form which entitles a person to purchase against a concessional rate. We have an E1, E2 form which deals with the sale in transit. We have an F form dealing with branch transfers. We have an H form dealing with deemed exports. And I form dealing with SEZs. All these forms are going to be abolished, and all these exemptions will also go away. Instead of exemptions, in all cases there will be a tax with a corresponding credit. The whole idea is to have an IT driven mechanism with taxes and corresponding credits rather than a document driven regime wherein there is a scope for corruption and there is also a scope of a lot of administrative difficulties coming in the front. And that takes me to this aspect that yes, there will be a tax. The getting of the credit is of course subject to certain conditions, and some important conditions will imply a change in the processes which many companies will undertake. There are few essential conditions for claim of credit. The first one being that you should have received the goods or services. You should have also received the tax invoice in relation to the goods or services, and you should have filed the return. Of course, the credit should not be something which is listed as not being eligible for credit. Up to these number of conditions are even existing today, and most of the industry would be happy with these types of conditions being there to ensure a smooth flow of credit and also to ensure discipline in the industry. However, under the GST regime, there are two additional conditions which have been inserted. One condition says that the vendor should have paid the tax, and this is where companies will have to make sure that their vendors actually go ahead to the government and pay the tax, and therefore vendor compliance is no longer only the vendor's responsibility. To some extent it becomes the customer's responsibility or the company's responsibility as well. And more importantly, merely paying the tax is not enough. it is important that the vendor also uploads these tax credits into the tax account of the customer. And that is where we are embarking upon an ambitious project wherein all the credits in the country will be digitized through a common GST portal. There is a Section 25 company called GST Network Limited which has been incorporated for this purpose, and that company is owning this portal, which is to be developed by Infosys on a turnkey basis. Once this portal is developed and the registration module is already on, SSEs have already started transitioning their existing registrations into the new GST regime. Once the other features will also be announced in a month or two, and thereafter all the returns will have to be filed onto this common GST portal. On the basis of the returns filed, the credits will automatically flow to the purchaser, and there will be a matching concept, and only on the basis of matched credits, the credits will be available to the customer. And that is where we see that there is going to be a sea change in the way the things are going to operate in the future. In fact, to have this type of a concept, we have tried to divide the return filing into multiple phases, and there will be at least 3 uploadings every month. The first uploading being an uploading of the incomes, which is known as GSTR1, which every organization will have to be uploading by the 10th of the next month. When they are uploading this information, all the sales will have to be uploaded. These sales will get classified as B2B sales and B2C sales. In case of B2C sales, there will be an aggregate sale figure which will be uploaded. For B2B sales, invoice level detail has to be uploaded onto the GST portal along with the GST TIN number of the customer. Based on that information, based on that uploading, the information will automatically get populated into the buyer's account, and the buyer will be expected to match these credits along with the credits which are lying in his books of accounts based on the invoices received by him. There can be various situations which can exist. In both the places there is a match, there the credits will flow seamlessly. In situations where the credits are uploaded in the portal but not existing in the buyer's system, he will have an opportunity to defer the credit till the time the goods or services are received by him, or till the time the transaction is approved within the organization. However, this deferment is possible for the financial year only up to the end of September of the next financial year. So that time limit is reasonably fair, and within that time limit it will be important for companies to make sure that they account for all the invoices. The third situation is a situation where a vendor has given an invoice to you which has been accounted by you and paid for by you, but the vendor has not uploaded it into the GST portal. In this case, you are eligible to self-claim the credit on a provisional basis. The provisional credit will be available only for a period of 2 months, within which you are required to chase the vendor and make sure that he uploads the correct tax to your account. If he does not do that, the credit which you have claimed will be automatically reversed along with interest. And that is where we will see companies set up systems and amend the purchase processes to ensure that a free flow of credit happens to them. There is also one more process known as income reconciliation, which happens through GSTR 1A. I will not go into too much detail because it's too technical to go into that. Once this entire process completes by the 17th of the next month, thereafter you will have a final income which will be defined by the GST portal, and its final expenditure, output tax and input tax will be automatically calculated, and the GST portal will advise the amount of tax to be paid, which has to be paid by the 20th. And you have a uniform process of monthly returns irrespective of the turnover across the country. Please note that if you have multiple registration, this entire process has to be followed for each state where you are required to be registered. And that's where we see that there would be some challenges. On the procedural front, you have to ensure that your registrations are transitioned in time. Your invoices are compliant with the new format of invoices prescribed by the government. Your invoice numbering series is the way the government wants you to do that, which is basically to have only an alphanumeric series of invoice, not have any special character in it, and have a continuous series numbering. The debit and the credit notes also need to be serially numbered, and they also should not contain any special character. More importantly, a debit note and a credit note will be recognized only when issued by a supplier, and only when it is linked with a corresponding invoice on a one-to-one basis. As of today, there are situations wherein a single credit note is issued against multiple supplies from multiple invoices. In this scenario, it will be important for the trader to split the credit notes into multiple invoices to make sure that each credit note represents one invoice against which the supply was made. All in all, on a procedural front, we might see an initial period of confusion wherein there is a change in the entire process in which activities will have to be carried out. And that's where we believe that the transition into the new regime is going to be very, very important. Any organization will have to undertake that transition into multiple steps, and if it is done in a right manner, they will definitely be able to enjoy and reap the benefits of GST. But if it is not done in a proper manner, they might end up with certain surprises and hidden costs. There are 5 broad steps towards this transition, and the first step for that is going to be understanding the quick need based on the requirement of the industry. Whether there are any exemptions which you are claiming, how is it going to impact you if those exemptions go away? Will your customers be ready to pay you the extra GST, or will it become a part of your costing? What all taxes you don't charge today but will become taxable in the future? For example, if you are a trader, you are today only charging VAT, but in GST you will have both CGST as well as SGST components coming into play. Will there also be a need for any changes in your processes with the branch transfers becoming taxable and a free flow of credit available? Is there a need for relooking at your existing warehouses? Is there a need to relook at your existing number of depots and branches? Is a question which many companies are examining. They are also examining many other business processes to see whether there is a possibility of any business process re-engineering. Especially on the vendors front, there is always going to be a need for a price realignment, because there would be situations of various hidden non-creditable taxes today which would become creditable in the future. If that be the case, necessarily there will be a need for a reduction of the base price and a provision of a discount in that manner. And this is where in the initial phase the markets will discover the prices, and who gains the benefit out of this will depend on the agility of the respective players in the business parlance. In this context, the government has also come out with an anti-profiteering measure to make sure that if any organization gets a credit or a benefit because of GST, that benefit has to be compulsorily passed on to the consumer. There will be an authority set up to examine whether there is any profiteering measure, and there will be penalties which will be set up in this regard. And that's where people will have to look at adequate documentation to make sure that their invoicing, their accounting systems are in place, and more importantly, closer to the GST regime, the transition provisions will become important. It may be advisable to have a minimum level of inventory, and whatever inventory is there should be of proper excise paid goods with a corresponding excise invoice, so that the credits are easily available whenever the transition happens in the new regime. With that background, I think it's a time to really welcome GST. This has been a reform which we have been waiting for a decade and more. The industry has been demanding this, and we have reached somewhere very, very close to it. So let's pray for the best. Let's hope that we have it on 1st of April or at the earliest opportune time. With that, I would like to thank you for this patient hearing.